When a market halt occurs, it can feel alarming for investors, especially those who are unfamiliar with how financial markets manage extreme volatility. But a market halt is not a sign that your investment has disappeared or failed. Rather, it is a temporary pause designed to protect the market from panic-driven decisions and disorderly trading. A market halt, sometimes called a trading halt or circuit breaker, happens when stock prices move too sharply in a short period of time, either upward or downward, prompting exchanges to pause trading for a set duration to allow investors time to process information and restore balance between buyers and sellers. During this pause, your investment does not lose or gain value in real time because trading is suspended, meaning the last traded price remains frozen until the market reopens. Importantly, ownership does not change during a halt. You still own the same number of shares, and the underlying company has not suddenly changed its fundamentals simply because trading has stopped. Market halts are commonly triggered during periods of extreme uncertainty, such as major economic shocks, geopolitical events, unexpected policy announcements, or sudden market-wide fear, and they are intended to prevent emotional selling or algorithm-driven crashes that could distort prices far beyond fair value. As Warren Buffett famously said, the stock market is designed to transfer money from the active to the patient, and market halts reinforce this idea by forcing investors to pause rather than react impulsively. While trading is halted, institutional investors, market makers, and regulators assess liquidity, order imbalances, and risk exposure. And companies may also use this time to release clarifying information if a halt is companies, such as during pending news, earnings announcements, or regulatory disclosures. For long-term investors, a market halt rarely changes the intrinsic value of an investment, because the company's assets, revenues, and long-term prospects remain intact, even though short-term sentiment may be shaken. However, for short-term traders, halts can introduce uncertainty, as stop-loss orders cannot be executed during the pause, and prices may gap up or down once trading resumes, reflecting accumulated buy and sell orders. This reopening process is often accompanied by higher volatility, as the market works through the backlog of orders and reestablishes equilibrium, which is why prices may move sharply immediately after a halt without any new information emerging. Market-wide halts differ from individual stock halts, as the former affect the entire exchange and are usually time-based, while the latter may remain in place until specific information is disclosed or reviewed. It is also important to understand that halts are a sign of market safeguards working as intended, not a failure of the system, because they aim to maintain fairness, transparency, and orderly trading during stress. Investor psychology plays a major role here, as uncertainty often feels worse than loss itself. But history shows that markets tend to stabilize after halts, and in many cases, they recover once fear subsides and rational pricing returns. As Benjamin Graham wisely noted, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. And market halts are a reminder that short-term votes driven by emotion do not determine long-term value. Ultimately, what happens to your investment during a market halt depends on your time horizon and strategy.